Hi everyone, welcome to the weekly stock market update. Now this is the public one, so it won't necessarily have all the depth and detail that I give, and specifically the individual stocks that I give in terms of what I've bought, what I'm holding and why to my Great Investments program. But the public one, which I'm giving you now, is still very good indeed. So buckle up and grab a pen and paper if you wish. It's going to be good. Remember, this is not individual financial advice. It is not a solicitation to buy or sell any individual security. So what's valuations? Well, the valuations at the moment mean that you're paying $29 for every future dollar in profit of Microsoft stock. Okay, so when you buy a stock of Microsoft, you're paying $29 to buy it for every dollar of profit that it has. Now, you can see there's a lot of red. That means these are the expensive ones. However, you will have noticed, the brighter ones amongst you, that in actual fact, the stocks which have done the best are some of the ones which have the highest valuations, are the most overvalued. That's because value is not the only factor which moves stock prices. Okay, growth, revenue growth, sales growth, expectations of future growth in earnings, profitability, and so on do that. Remember, revenue means the same as sales, earnings means the same as profits. So we're going to look at some of these in green because all other things being equal, we'd like some of the cheaper ones if they've got good growth prospects, wouldn't we? Now, looking at the week ahead, we've not had this week things which would move the markets. There are things like Broadcom which has soared and moved, and one of the ones which you'll remember from last year was one of our AI picks, which has moved those individual stocks, and Costco is an old favorite of mine from the past as well. Some of you may know we've talked in the past about Micron, Accenture can be a good AI pick. Cintas has been one which we've discussed before, so has Paychex and so on. But I'll go through specific stocks as we progress through this. Don't forget to like, comment, share, subscribe on all of this. You will know that the manner in which I look at individual stocks is I like to tick every single box. If you're on the Great Investments program, you have access to my whole 10,000 stock spreadsheet. Okay, as well as, of course, most importantly, access to me. This proprietary algorithm, which measures valuation of individual stocks, their revenue growth, and their dividend yields, that's probably the most important column because it allows me to narrow things down, and we weigh valuation and growth and dividend yields by factors that we've used from academic journals that I've written about in my Financial Times columns, on my Bloomberg TV show, in my books, where we've relied on the research from 3 Nobel Prize winning economists, Eugene Fama, Daniel Kahneman, Richard Thaler. Anyway, the stocks that I'm going to ever put in my portfolio, my son's pension, are going to tick those boxes. As a hedge fund manager, that robustness of approach is incredibly important. Croakey comes from Goldman Sachs Wealth Management, cash return on capital invested. I want that to be stocks in the top quartile. Now, you cannot simply look at that alone. If you look at that and ignore this, you're going to have problems. This comes from the hedge fund industry. Momentum tends to persist, but it's not guaranteed to, so we do want to tick that box. In other words, we need that to be green. Sortino and Alpha come from the hedge fund industry. Sortino meaning high average return, so a stock that goes like this, and if it dips, it tends to have shallow dips and quickly rebounds and then continues along. Well, that's of course the ideal investment you want. So we want that to be as high as possible, but I mark those as green, and that then allows me to filter stocks down. That's my approach. We have a lot of people who are cash-rich, time-poor professionals or entrepreneurs or business people, or as a person I was speaking to earlier today, who is coming up to retirement, he's about in his 50s, and he said, who are the people who use this on the Great Investments program? And I said, well, they're usually people who either are professionals with little time and want the hand-holding, or there are people who, when they retire, they want to be on top of their portfolio and have it work for them, and want both sets of groups want access to me. Now, I have a whole team who work for me. There's the data team who pull the data in. There's the graphics team who pull the graphics in. The whole point is that it is those people who are then working for the people who are part of the Great Investments program. I just want to give you that context. You understand where everything's coming from. This is not something which has just sort of popped out of the air. It is based upon, as I say, my Financial Times columns, which I when I used to write my weekly columns, and there's 200 published in the Financial Times and my books, we'd put all that in and then adopted it into the hedge fund as well. And if you're wondering how well it performs, well, I'll show you later on. When there's a tailwind, like this year and last year, of course, incredibly well. When there's a headwind, like 2022, and this is what you need to know, then we had to wait out of the market for most of the year and had to sit with 0%. Yes, I said that, 0%, albeit the market fell 20%. And some stocks like Meta fell 75%, but we had to sidestep and avoid everything because if you can't find a good stock, you can't find a good stock. Now, that'll happen once in 7 years. So if you're wondering what average performance is like, well, average is erratic because you've got everything from this year and last year where the stock market's up 30 to 55% depending on the index. And our performance is like last year, up 80%. It was last year. But the year before last, 2022, 0. So what's your average? 40% over 2 years? Well, it seems a bit of a silly thing to say because you've got 0% 1 year and 80 the next. Both are outliers. So the way I look at it is if the last 7 years repeat themselves over the next 7, which there's no guarantee they would do in the market, but if they do, then not bad. But it's out of our hands. If there's a tailwind, we do incredibly well. We grab those opportunities. If there's a headwind, we don't. And even if we get one bump a year, where you get an 80% rise because the markets are great, and then after that you just do a mediocre 6-7%, let's say, every year, just bank interest, let's say, well, at least you just almost doubled your pension and you're doing bank interest on the rest. So you get the idea that you want to be in a position to capture all of that. And so much is dependent on the market tailwinds anyway. As Warren Buffett often says, if you're making a bet on the country, that's what investing often is. Now, the past year, this is what's happened. Now, I suspect that when I select stocks going forward for the next 12 months, and for my Great Investments program, what will happen for people sorting out their pensions, and now's a good time to sort out your pension because you get a bit of quiet time during Christmas and you're motivated into 2025, into the new year to do it. Then when we're sorting out all of this, I think over the next 2 years, we're going to get a repeat of this. By that, I don't mean 20% in Microsoft in 2 years or 55 in Oracle. What I mean is it might be 55 in Microsoft and 20 in Oracle. What I mean is this mixture of numbers. Okay, we're going to likely get that mixture of numbers. And that's good. So I'm excited. Now, why did I say 2 years and not 1 year? Well, because 2 years is easier to say than 1 year. And I always like to manage my expectations with my son's junior ISA, my wife's SIP, and my own pension on that as well. Okay, and I tend to hold, as you will know, for 12 months. So this is what the past years look like. The ETFs, I've just done a video on crypto on those on both TikTok and YouTube. I've done the detailed one with charts and a detailed strategy on exits for the Great Investments program on all of those because there's interest. My students wanted to know, others wanted to know about those. So where are the markets and where are we? Well, of course this tells us it's expensive. You don't need me to tell you that the price to earnings, that means how much you're paying $33 for every dollar in profit. Okay, of course it's expensive. Does that mean you don't invest? Of course not. What you need to do is keep a close eye in case there's a pullback. So where are we? All good, all good. Now that's earnings. Profits have gone up 11%, but market cap has gone up 32 and revenue's only gone up 5. What does that tell you? It means there's been price inflation in the asset. Imagine this. Imagine you've got a flat, okay, and the flat pays you a certain rent. And out of that, after costs, you've got a certain profit. So the rent, you've put up 5%. Your profits, because you managed to cut some costs, has gone up 11%. But the price of the flat's gone up 32%. You might even think, it's time to sell this flat. It's a bit overpriced. Okay? And that's where we are. But that doesn't mean you immediately ditch the flat, right? And we'll keep a close eye on these things. Just to tell you where the most expensive price-earnings ratios are, higher the number, the more expensive it is. But it might still grow because this is where the growth comes in and which sectors. Now, I don't tend to look bottom up from sectors down. I look at companies bottom up. So I don't do top down from sectors. I do bottom up individual companies. I'm looking for companies where this is as low as possible and this is as high as possible. Got it? I want value to be low. I want it undervalued, and I want growth to be high. Because if you only looked at this, you'd be missing half the picture. And if you only looked at this, you'd be missing half the picture. The only way to do that is to have my data team working for you and getting my data team and the graphics team putting it together and being able to say, okay, this is what the computer says. And the best thing to do, and the most important thing to do, and how and why your fund manager messes it up, is because we will look at across all the UK, European, US stocks that can go in my SIP and ISA, or if you're from America in your 401k, because we've got clients from around the world on the Great Investments Program. The problem becomes that your fund manager will only look at, say, might be just looking at a theme like healthcare or a geography like the United Kingdom. So they underperform because they've got their hands tied behind their backs, and they've got a conflict of interest that they only earn fees if they've got your money. And because of that, and we don't manage your money, we just give you the data and access to me so you can make the decision to manage your own money. So we don't charge ongoing fees at all for that reason. We avoid that conflict of interest because fund managers have it when the markets are falling. They still want you to stay invested with them because otherwise they don't earn fees. Whereas I'll happily tell you, well, I'm holding cash like in 2022. It's those years which fall, which we avoid, which means that we do a hell of a lot bloody better than those fund managers do. In fact, institutionally, we're bound to do better than them because we look at all 10,000 stocks. They simply don't. They will break it down by geography or theme. And if you're wondering why, it's because they've got so much money under management, they have to. You don't have that problem because you don't have 500 billion under management. Okay, but you don't use that advantage. Instead, you give it to them with 3,000 other clients they've got, some who've started earlier, some who started later, some who want high growth, some who just want stability, and you just mixed into the pot, and they're happy to lie to you and take your money off you because they get fees paid for it, whereas you should be controlling your own, which is why governments create SIPs, ISAs, and pension funds. So how's the US market? These were some of the biggest rises over the last 7 days, as you can see. Okay. You can see their price earnings, and yes, I know Tesla is ridiculously expensive as a car company, but it may not be so expensive as the United States President's best friend's company. Got it? Two different things. So I, as you will know, well, if you followed the Great Investments Program, you know what I own in that, don't you? Now, price earnings on the UK market, a bit cheaper. Britain's a bit cheaper. I was at the London Stock Exchange this past week, as you will know from some of my broadcasts, and I'll talk more about it during the course of my future broadcasts. And you can see here, earnings have dropped 38%. Revenue has dropped 6%, but market cap has gone up. So perverse. It's a bit of a cheaper market. We'll keep an eye on it for you. Price earnings, growth. Now, for the UK market, and we do on our database look at every single UK company as well. And I might cover more UK stocks for you actually going forward if you wish. Forecasted growth is that, price earnings, those. We want that to be as low as possible, this to be as high as possible. But they're not the only two factors. We want CROCI because Goldman Sachs Wealth Management use cash return on capital invested, and their quantum database team found that companies in the top quartile generate 30% per annum on average as a basket. Not every stock in the basket, not every year as a basket, but overall, so we need that box ticked. Okay, and that's in our data. We just get the data to do the hard work. We get computers to do it. We're slave drivers. Computers don't cost money in that you don't have to pay them a salary. So we just get computers to do it all. Top gainers in the UK market, there were these. Okay, over the past year, though, not fantastic necessarily. PE ratio on British American tobacco, price to sales, only 2.5. Price to book, 0.9, which is Warren Buffett's favorite. Price to profits is 18 on Diageo. Anyway, this is alone not enough. You need to look at the chart, and we want to look at momentum on the chart as well. Most importantly is my value growth income score. Exchange traded funds, which ones over the past month have been doing the best? Hydrogen. That's got to be Donald Trump trade. Okay. What else is coming up which sort of caught my eye on this in terms of moves? Well, obviously you've got some of the Bitcoin ones. Those are the ticker symbols, which have done well. India again, Goldman Sachs was just done a report, and I'll do a podcast. I do have a podcast on the India side of things. Obviously, artificial intelligence. Now, one of the things you can always do is if you find interest in something, the first part of any ETF is the issuer, Global X or ARC. You can go to their website, put in the ticker symbol, and you get a whole bunch of data on which stocks they happen to own. Now, that's an amateur way of doing it. What you really want to do is look at Sortino, alpha, volatility, momentum, the chart. That's what I do for my clients. Get the data, do the graphics. What the amateur does is they'll go to the website and look at, sounds good, artificial intelligence sounds good, sounds important, and then they hope for the best, and then they wonder why they're underperforming. Okay, year to date, this is where we are. NASDAQ, there's the S&P. Okay, another phenomenal year. If we get that again over the next 2 years, if it takes 2 years to get that, which we will, I'll be over the moon, because the pension pot and my sons and everybody else's and the money I hold outside the pension, because pension fully invested, does bloody well, okay, obviously. By the way, if you want to know more about any of this, just go there, alpeshpatel.com/links. You can read my articles on LinkedIn. You can look at my free material on the course, get a tour if you wish, the free investing material, free copy of my book, Investing Unplugged, which was an international bestseller. It's one of my 18 books, free video replay and detail of my last investing webinar as well, and a free copy of my Financial Times book, The Internet Trading Course, the complete course in online investment by me, and free daily there as well. Okay, so you'll get to learn more. Now, where are we on all of this? These are the various sectors, and let's go through the various sectors. Communications have done well, financials. I mean, these are phenomenal numbers, and you can imagine the companies within those have done incredibly well as well. There has been a massive tailwind in the markets over the last 12 months, and I'm going to say it's going to happen over the next 24. Okay, we're going to get 1 year where the market falls and 1 year where it rises, but I don't know which order it'll come in. Probably the rise next year and the fall the year after, but it could be the other way around. That's why we're looking at it over a 2 year period. The factors that we look at, which are the most important, are value, growth, momentum, and you can see that's the one which has blown the market out of the water. We want stocks which are growing, which also are undervalued, and which are also showing strong momentum. Momentum comes from the hedge fund industry, my industry. It's incredibly important. It's considered the poor cousin, but it's incredibly important. We want that subset of a subset of a subset. Got it? And that's critically important to us. Markets over the past year, NASDAQ's up 32, the S&P, NASDAQ 35, S&P 32. Phenomenal. Completely blown the doors off. Okay, it's that tailwind, not my genius, which I don't have. It's the tailwind in the market which has led to phenomenal performance for us. Okay, and that's what's been critical. So like I said, go to links and click on all those buttons actually and get all the stuff. So let's continue with a bit more. FTSE 350, this is what's happened over the past month. Okay, over the past month, this is what's happened. And I'll cover these in future. But let's look at the S&P and where we are on it at the moment. Now for me, if this trend were to continue, that's the projection forward. It is overbought. I know it's overbought. It is a bandwagon. It is something which will at some point correct and fall as it done here. But it's very, very simple for me. At the moment, this is going upwards, so I don't need to do anything. In fact, I bought some 2 times leverage exchange traded funds in the S&P 500 to add to my 3 times leverage and add to my tracker. Okay, now, here's the interesting thing. If that were to fall, if prices were to fall but this rises, then that's called a baby bear and I can ignore the market. If it were to fall and this also fell, that's called a mama bear and I can still ignore it as long as the MACD doesn't fall below its own moving average. Got it? The NASDAQ, there we go. Similar to the S&P, bit overbought, but I don't have a problem tracking that either. FTSE 100, slightly different story, seems to be hitting something of a plateau, but has bumped up a little. GDP figures weren't good, so this is why your pension is screwed, because most people invest with fund managers thanks to their terrible IFAs domestically in the UK market. And then when you keep bugging your IFA, they will say to you, oh, well, those US stocks are a bit, they don't earn enough fees basically by putting into US stocks. And they'll say, well, those fees, currency risk, volatility, all this bollocks. And of course, the problem with that assessment is that if you're missing out on a 35% rise in just the index, then a 1% currency fluctuation either way, which could work in your favor in any event, which if you started at the start of the year would have done because the dollar's risen, they'll just stop you. They'll just constantly force you to be poor because they earn more money from UK fund managers. Okay, they're bribed more in all their kickbacks. And it's a scandal, a bit like the post office scandal, which sooner or later will come out, that the IFAs are just hand-tied and they have a massive conflict to keep you invested in a falling market because they don't earn fees if they don't, and to keep you invested in low volatility because you're more likely psychologically to do nothing because you're unaware of the opportunity cost of what you could have missed. They won't even, in some of their examples, even tell you that you could have just bought Microsoft or an Nvidia. And then they'll shove you into a fund which has next to has 0.01% in any of those stocks and to try and keep you quiet. That's if they listen to you at all. Go ask your IFA or wealth manager or your HR department, what the hell has the employer invested me in, for God's sake. Employers have a conflict of interest to make sure your pension doesn't grow too quickly. Otherwise, you'll retire early and leave the bloody company. They have an inherent conflict of interest as well. Okay, these conflicts of interest are what are killing British pensions. And I've written to the Treasury about it and the Chancellor. I don't think people are pretty much sophisticated enough to understand it, and the vested interests are too big. Top 10, I've said it in the BBC, I've said it on the BBC, I've said it in my books, I've said it in the Financial Times, so it's not as if it's something new. S&P top 10 stocks, price over the past month. These are the biggest movers. Obviously, Bitcoin has helped that one. I will again go through some of these for my clients. Warner Brothers, of course, was one of the ones we'd picked ages ago and did nothing for ages and then shot up. Netflix, you'll be familiar with, is one that I've been monitoring for you for, donkeys, over a year now. And it's gone up 100%, now more than 100% as a result of that. And of course, Tesla, as you know, since Trump won, I got back into after he won. You might say, well, clever person would have got him before. Yeah, but I didn't have the time machine the clever person has. And afterwards, it's been fine because it's up about 80%, I think, now. And I bought more. On the Great Investments Program, this is the kind of stuff we're looking for. We're looking for those strong trends. We're looking for very small down moves. So when the inevitable falls happen, they should be low. When the rises happen, the Sortino should be high enough that the dips are narrow. Okay? If you are willing to take bigger dips, you've got more choice of stocks. And you only find that out when you actually buy something and you realize, oh, actually, I don't want that. I want things with very reliable moves. So this is one that we've got, which I'll talk about to my Great Investments Program students that I like and I would happily buy more of. And those are the returns we're looking at based upon the existing trend continuing, 87%. Okay, so that'll come on the program. Warner Brothers, I mentioned earlier, was one of the ones which had come up, and you can see it's now bouncing back up. I wouldn't buy more of this now because the volatility is too great, and this is the most radical move up were it to do it, which I don't think it will. So Warner Brothers has given an illustration of what not to buy now, just showing you how things can take a while before they actually eventually move up. This is another one for the Great Investments Program, which is going to come up, which I'm going to show them because we think we've got 133% return on that. Again, another one which has steadily moved up, but without too many downfalls. So we look at these drawdowns, drawdown danger, depth, and duration, and that's going to be going in the pension as well. And it's a value growth income 7, so we particularly like it as well. On that, we've got another one which is going to go in from the Great Investments Program. They'll see that. My students will get that. Where we think that trend is likely to continue. Even if we don't get 190 and we only get a 40% return, hey, we're happy. Okay, and this one is because we see the momentum gradually rising, and we're confident on that one over the next 12 months as well. But I'll put that in the program. How did we do in a year like 2023 when the market had a massive tailwind? Well, this is what happened. We didn't know Nvidia, which we had from January 2023, would produce 238%. If we did, we would have bought that and nothing else. So even when I tell you I think these are the projections, we don't have enough confidence to put all our money in just one company. That'd be ridiculous. It'd be too much risk. So these were some of the ones from January 2023, and you can follow that on my YouTube anyway. And then we hold for 12 months unless they drop a certain percentage. And that gave 80% in 12 months. Wait a minute, why 80% if that went up 238? Well, because there were some which went significantly below 80. They might have done 0%. There was one which was still negative after 12 months. And that's why the average is 80. Had we known NVIDIA was going to do that, we'd just put all the money in there. Probably gone to Ladbrokes and said, give me odds of 1,000,000 to 1. It's going to go up 238%. So we have a confidence level, but it's not so confident that we would auction my mother-in-law into it. Okay? Like I said, if you want a tour of the Great Investments Program, you're not already on it, do come and join. I was at the London Stock Exchange. My ambition eventually is to float that company, is to float the whole program and the software and the access to the expertise, because I want a different type of asset management company. I want the kind of asset management company where you hold the assets, just like Uber doesn't own cars, Airbnb doesn't own apartments. I want an asset management company that puts St. James's Place out of business, because I think they provide a terrible service. They destroy people's pensions by not providing the growth that those people could easily have got for the risk appetite those people have. Instead, they blood suck them out of fees, as the Times and Telegraph and everybody else is reporting. They're not the only ones. Your IFA is doing the same. And what I want is people to be empowered through the work I've always done on the BBC and the Financial Times, on my Bloomberg TV show, by giving people the data and the education. Data and education. If I give you the data and I give you the education, and by education I don't mean go away, read some books, I mean one-to-one tutorials with me, then surely through that bespoke hand-holding and no ongoing fees, you should be generating and doing better. The data, value, growth, income, Croki, performance, Sortina, alpha. This is an early version of how our tables used to look, and it used to be 10,000 stocks down there. Makes life a hell of a lot easier, because you've got basically your own investment management team for you, who produce the data for you and the graphics for you, so that you've always got that. And as we've expanded the company and we've got more staff abroad now, we've got more data people, we've got a couple of people who are good at data analytics, a couple of people who are good at AI, though we're playing around with AI and that'll help us improve stuff, including giving more specific, detailed, bespoke stock reports. We're expanding, and I'm pleased. So it's good to be at the London Stock Exchange this past week. Put another way, it should be a no-brainer. So we have a bunch of business people who sign up to the program because they say, you know what, we've got 500k, a million, or whatever. This is a no-brainer, because even if you manage to get me a 20% more than I would have done myself over 2 years, I make 100k, or over 3 years, I make 100k. So it's a no-brainer, they say. Got others who've got little as 100k, and they say, well, wait a minute, I've got this for the rest of my life. So as I get more money going forward, this helps me. That was the return in 2021. 2022, it was 0% because the market fell and we had to hold cash most of the year. And 2023, I just showed you. 2024, we'll let you know this year. If you want to go back to all the way to 2004, where an independent third party has audited all our results anyway, then click on that here and you'll see all our results since 2004, and it'll blow your mind away. Okay, 2004 is also when I launched the hedge fund. So all of this work we started producing for the hedge fund, and then I spun this out and said, well, actually, we've got all this work done. I don't think we could have done any of this had I not launched the hedge fund, because it was an expensive exercise which needed the investment from the hedge fund to put the money in to develop all of this research and the staff and the team that we have around the world. These are the two things people want the most. They want the portfolio, the database basically, and they want access to me. Everything else is nice, and then they realize, oh, actually, I really like this, and I really like this, and I like this, and I like this, and I like this, and I like this, and all the other stuff. But initially, it's this and this and this are the two things. And we have a very systematic, process-driven approach to save them time. In fact, I like to call it the 7-minute pension. There's an online form they fill in once I educate them and give them the data that allows them to sort out their pension in 7 minutes. Anyway, if you're ever interested in any of this, go to the links, get a tour, go there, alpeshpatel.com/links. If you're watching this, just make sure when you get the tour, ask Paresh for the discount from the webinar, what I call the webinar discount. These are some of the books he and I have written. When your pension gets too full up, we use this in order to make tax-free gains, because that's tax-free, and we can still make the gains using this. That's a separate issue. So first issue is pension. Once the pension's full up, then you can use that to make tax-free gains with the excess capital. Okay, so it's all of that. That's what you want to have a look at. Have a look at, this is all part of my campaign for 1 million, to teach 1 million people how to be better investors. So the people who sign up to the Great Investments Program, in a way, are the ones, and the future IPO that I've got planned and venture capital investment I've got planned, they're the ones that allow me to do the philanthropic stuff, which is take the time out to do the campaign for 1 million, to teach 1 million people around the world how to add an extra 1 million into their pensions across their lifetimes through better investing. A million times a million is a trillion. Thanks to social media, you can do that. We're already at nearly 500,000 followers on TikTok, 50,000 on YouTube. So we're going to keep building that. We probably need, I don't know, 10 million in social media to be able to impact 1 million people, I suspect, at least. And those are only 2 channels. Follow me on LinkedIn. I was at their offices recently. You might have seen the videos. I'm a top voice there. That's me. You always need to do diligence, anybody. You need to know somebody's credentials. Do they know what the hell they're talking about? And I think LinkedIn's the best place to do it. If they're not on LinkedIn, then stay clear. Okay? Because what the hell? Why aren't they? Okay? There's something wrong with them. They're hiding something. It's very obvious. Okay? So the reason LinkedIn's a good due diligence platform is because if you look at all the people who are connected to them on LinkedIn, you've got CEOs of banks and so on. If somebody's lying or exaggerating, like the Chancellor allegedly was, somebody's going to find out because they're going to go through their profile and go, wait a minute, you're a bank teller. You didn't do this, because you're not going to get all those connections, and they stay quiet. So it's a rather good place to be, and you'll see from the comments and all the rest of it. So I've been made a top voice. So is this guy. So do have a look on LinkedIn as well, and that's on, well, you better find that through the campaignforamillion.com. Listen, thanks very much. Keep an eye out on all the free resources on Telegram and so on, and the webinars coming forward as well. And I'll be doing some before Christmas, between Christmas and the New Year. There's a lot more coming. Okay, we're going to be putting the price up of the Great Investments Program, and the reason for that is very simple. The stock market has gone up. We're keeping up with inflation and the returns we make people. Will it go up 35%? Well, I think last year it went up 100% from the start of the year to the end. So we're going to go up 100%, probably not 100% rise in the price, but I'll see. I'm just taking feelings and soundings from people. So, well, get a move on. Thank you all very much. And hope for all the people who do sign up to the program, I look forward to seeing you on the IPO journey. That's the ultimate ambition. Thank you.